Setting up your meeting for Facebook Live.
Perfect.
Ba-ba-ba. All right, we should be good to go. Let me just double check, make sure it is working. It says live on Facebook. I guess that means we're live on Facebook. Hi, everyone. Thank you so much for joining us for another Money Monday. My name is Henry Gibson. I'm your friend in finance. Bear with me 1 second as I try to share this. Boom. Oh, Chris, you were already able to share, weren't you?
Yeah, look at me.
Oh, man, there we go. All right. And boom, share now public. All right. So so thank you so much, everybody, for joining us. Got some pretty exciting stuff here because today on Money Monday, like I said before, we have a special guest. With us, we have Chris Tanner. He is a team advisor at Plan and Act, just like me, but he's been with the firm much longer than I have. And actually, he's been with Plan and Act since before Plan and Act was Plan and Act. So, Chris, why don't you tell us a little bit about yourself?
Thanks for that intro, Henry. And hi, everybody. A little bit about myself. Okay, so I actually grew up in another country. I grew up in Poland, moved to the States in 2011. So kind of first half of my life overseas, second half of my life here in the States. I went to Wheaton College for university, studied economics there. And then soon after that, I got connected with Plan and Act Financial Planning as the firm. And it's turned out to be really the dream job. I'd say I'm one of few people that that's gotten to get connected in the career and with the company that they want to stay with their whole life straight out of college.
That's pretty big too.
Yeah, I'm grateful.
That's huge because I think that because I think we both kind of recognize that with Plan and Act, it's not just about finance. We've talked about this before. The whole culture that we have is all about kind of giving back to everybody else and helping everybody else too.
Yeah, and so it's fulfilling. So I completely agree on you.
That's awesome. So today we're gonna talk a little bit about how do you actually pick a financial advisor? Because Chris will you can actually probably speak more to this, that there's a lot of not so trustworthy people out there in the financial field. Could you give us some examples of, because you've told me some stories about this kind of stuff before. Would you mind giving us some examples of that?
Yeah, absolutely. So I think untrustworthy people is one thing, and unfortunately, in every industry, really in every circle of life, you'll interact with folks that just don't have a great heart. But what I mean, for me, a starting point is typically is to not question people's motivations, but rather to question what are the incentives in place. And unfortunately, with the financial industry, there's just a lot of business models which incentivize advisors to make decisions that aren't for the client's best interest. So that's really probably for me, the biggest grievance with the industry of financial advice and financial planning is that there is such a prevalence of business models that don't put the client first. And so, Henry, would you like some examples of just how I've seen that?
Yeah, because I think what you're saying and right now is that we ultimately can't assume the intentions of somebody trying to help us. But when we're actually looking at what do they have in place and what systems do they have in place, are those systems intended to actually help the client the most, or are they intended to help the person, that person who's selling to you the most? Is that kind of does that sound right?
Yeah, yeah, that sounds exactly right. And it's, even if the systems aren't intended to serve, say, the advisor over a client, that's often the result. So I mean, the best example that I can give is just from my own experience. While I was still in college, actually, I worked as what was called a college financial representative for a insurance company in the Midwest. Um, and there was a ton of great people working for that company. Here's where, like, I really appreciated the heart of everybody I worked with. They clearly cared for me, cared for, like, the work they were doing and the people they were serving. However, the model was commission sales. And so as a summer intern, I was trained on selling products, on phoning, calling clients, calling potential clients, mostly my friends and family and such, and getting them in for a meeting so that another financial representative could sell them insurance. And so I looked back at the end of the summer and saw, okay, all of the training, all of the equipping I got was learning more about insurance products. There's some of that, not even that much of that, and learning a lot about calling people on the phone and getting meetings. There was no training on what does comprehensive financial planning look like, what factors and needs need to be considered to create a whole picture. Yeah, so like I was taught that, and we were all trained to do that because that's how advisors there got paid. They got paid a commission on selling insurance. And all the while, we were all saying, we're comprehensive financial advisors and we have your best interest in mind. So I just got to witness that dichotomy firsthand.
Yeah, and so it sounds kind of like that definitely made a mark on you too, because you wanted to make sure you wanted to not only help people, but you wanted to be sure that you were helping people. That's what it sounds like, and that just wasn't the culture over there.
Absolutely, I feel like I never had the certainty that, like, the products we were presenting and bringing to the table were in my friend's best interest. But that's what I was there to do. So I would still bring in friends to have these conversations, and I liked the people I was working with. So it's like, it's probably going to be good. So what I've learned since, and actually receiving training, becoming licensed as a fiduciary advisor and receiving training here at Plan and Act, is that there's so much more to the picture that we were missing, that I was missing at the time. And it's not like insurance was never part of the financial picture. But there's so many more tools. There's so much more to consider. And as an insurance salesman, people that weren't paid to consider other options.
Yeah.
So,
yeah.
And we do what we're incentivized to do.
Yeah, you've talked about that before, because you said you've talked about the behavioral economics of things before, where basically if there's an incentive for people to do something, people will tend to do that.
Yeah, absolutely.
Yeah.
And even in spite of, I could see in my own behavior being affected by that, in spite of not having certainty about the products I was selling, I still sold them. So yeah, I felt that power.
Yeah. Great. So then you found your way to Plan and Act. So just so people can kind of hear, because we're a fee-only practice, can you explain what that is and what the difference is between that and like a brokerage or the insurance that you were doing before?
Yeah. So there's a few technical terms. I'll try not to get too deep into that. But Plan and Act is a fee-only firm, like Henry said, which means plan and active advisors get paid directly by the clients for providing services and providing advice. So the client is the only party that's compensating the advisor. The advisor isn't getting commissions or kickbacks from any other outside firm, maybe like an investment firm that has certain funds, mutual funds, or other investments. The plan and active advisors aren't getting any kickback for recommending any specific investment or any commission from an insurance company for selling a specific insurance product or annuity. So that's kind of the fee only space. Then there's really the vast majority of people that call themselves financial advisors are truly financial salesmen. It's product sales of financial products, because rather than being directly paid by the client, they're paid by a firm for selling the firm's products. And so that the exchange of money, the client actually pays a big brokerage firm for an insurance product, and the big brokerage firm pays their advisors a commission on that. So you can tell just from kind of the flow, the direction of payment there, the advisor is ultimately, in the sales model, is ultimately responsible to the firm. The firm is who's paying them, rather than the client. And with the fee only model, the advisors are beholden only to their clients.
I like that. I like the way you said it too. It's something that, so we have a dog, Chihuahua. She might try to break in, which is why I have that weight there. But one of the things that I actually tried to consciously do is I make sure that Molly and we split up who's giving her a treat, who's giving her a treat, who's feeding her this time, because people tend to become more beholden towards where is that treat coming from. So for a broker, the treat is coming from the firm and not from the client. So they're going to be more beholden to the firm than the client. So that absolutely makes sense.
Yeah, and Henry, I love the dog example actually, because my wife and I are on the wait list with a breeder to get a dog. We're about to have a new member of our family, and she is a huge dog person, and I never, like growing up, especially being overseas, we never owned any pets, and so I'm really excited for this next step of having a dog in the home. But I know if I'm not careful, Christina, my wife, is going to be the one that's always giving the treat and getting all the love, and I want the dog to be loyal to me too. And earn some of that affection myself. So it's so important who's giving the treats.
I think that's that might be that's kind of like a running theme that we've had so far tonight. Everybody's like, people are like puppies, because ultimately, like you said it before, everybody. It's not that the actual individual people are untrustworthy.
Yeah, absolutely.
But if all dogs are good dogs, unless they grow up in a situation where they have to do something not so good, and then they're not going to be good dogs. So people are like dogs in that situation. If they're in a system where they're getting money from a different source, they're not going to be. They might not hold your interest to the highest degree. And people are also like puppies. Investment advisors will hold themselves mostly responsible towards wherever the money is coming from. That absolutely makes sense. I should also say, if anybody has any specific questions for Chris or for how to find a financial advisor, feel free to drop a comment. I am keeping an eye on the comment space over here, so we will be able to answer your questions, any financial question that you might have. In the meantime, I have a question for you, Chris, because you mentioned getting training as a fiduciary, and you got a designation called an AIF. What is that, and why is that important?
Yeah, okay, great question. So the AIF designation, it stands for
we also
accredited.
we also both had the webinar recently on
Yeah,
on the AIF too. So this is a good refresher for me too.
yeah, good. It's perfect timing. So the AIF stands for Accredited Investment Fiduciary, and anybody that holds that designation has been trained in the practices that make up the fiduciary delivery of service. And so to understand what that actually means, I think we should define the word fiduciary.
Yeah, I was just going to say, what is a fiduciary?
Yeah.
Sounds like a type of vegetable, maybe a spice.
Yeah, not quite. So the fiduciary standard is a standard of care, ultimately. And what it means is that somebody who's a fiduciary to you is legally responsible to put your interests before their own. So common examples of fiduciaries in everyday life are actually like if you hire a lawyer, they treat you with the fiduciary standard. They're subject to the fiduciary standard, meaning they're legally bound to put your best interests first, your interests first. And if in any way you can prove that like they weren't doing that, then they can be taken to court. They're breaking their fiduciary duty. So in the same way, investment advisors are also supposed to serve their clients with under the fiduciary standard. And so the AIF, going back to just that designation, is training on how, as an investment advisor, what are the practices, the steps, and the systems for implementing that on a consistent basis with all your clients.
Gotcha. So then that way, when you meet somebody in the future, they don't necessarily know you, but you can go, I have an AIF, so I have specific training in how to make sure that I, going back to the puppy analogy, and how to make sure that I don't put myself in a place where I'm tempted to eat, to be a bad dog, basically.
Yeah, absolutely. That's a really good way to put it. And I think another like something that's important to mention here is if a question that was on my mind as I took this course and as I just became a fiduciary advisor myself was, okay, so yeah, fiduciaries, that's like lawyers are held to that, investment advisors are held to that. So why don't all investment advisors do it? And there's some technicalities there that exist just in our laws, which essentially allow a certain business model to operate not with the fiduciary standard. So actually, folks in the insurance industry, the way I was, they're called registered representatives under the law. They're actually not called investment advisors. And that term, registered representative, means you have a different standard, a suitability standard instead of fiduciary. And to an untrained kind of ear, really to most people, that sounds no different. They probably don't know what fiduciary means, and suitable sounds good. But the suitability standard is just a much lower standard and allows a lot more conflict of interest in the client relationship. And then there's one more way to kind of get around the fiduciary standard, which is that advisors can be dually registered, meaning they can be both a registered representative selling product and an investment advisor at the same time. So they can give investment advice and sell product. And what ends up happening there, usually in those situations, and just what I've seen, is that in a conversation with a client about the standards that they're upholding, they put on the fiduciary hat and say, I'm an investment advisor. I'm subject to the fiduciary standard, but then in actually delivering advice, they put on the salesperson hat and say the suitability standard, this lower standard is enough. And so that's how I'll operate.
Gotcha.
And
So
yeah.
how would you avoid that then? Because that sounds pretty sneaky. So how do you get it? How do you keep people from letting that happen?
Yeah, great question. So, like as Henry said, Plan and Act is a fee only financial planner. Fee only is equal to not duly registered. Any advisor that is duly registered can't say they're fee only. They may say something like fee based. So even that small difference can allows them to kind of gives them leeway. But you have to ask. Essentially, you have to ask your advisor, do the research. How do you get paid? Because if either they can't clearly answer that question, or it's clear that their compensation isn't coming directly from you, then you know that they're not fee only, which means they're not required to, in all cases, apply the fiduciary standard. So if you ask a financial professional how they get paid, of course, they don't have to answer that question, but if they answer that question, they have to answer it truthfully. So that's how you can find out.
Gotcha. And fee only, not fee based, no wiggle room, because otherwise there's just that temptation will always be there. And again, and like you said before, it's not that they're bad people. It's just the bad system, and you don't want to mess with that system because because eventually a push might come to shove, and you don't want to test what side their loyalties might be on, kind of thing.
Yeah, it's better not to test it. Exactly.
Yeah.
I prefer my money to be managed by somebody who I know is legally required to put my interests first, and not anybody else's or some firm's interests first. Yeah.
I like that, and I also like that you brought up that like attorneys and doctors are held to a fiduciary standard, and I know that Bob always mentions that we're basically like financial doctors. So basically, that's the kind of financial advisor you want if you're going out there. This is to everybody else. This isn't necessarily to Chris. If you're going out there and you're looking for a financial advisor, you want to make sure you find somebody who at all times has your best interest in mind, and that your continuing betterment is also, they're incentivized to keep making you better and better. And the other thing that you got to watch out for is like brokers. I think their commission fees, they take a commission when they went per trade. So the recommendations they make might not be necessarily a good trade. It might be a suitable trade, but might not be up to the fiduciary standard. Does that sound correct, Chris?
Yeah, it does. And in specifically with somebody who's a broker who gets paid to enter transactions for you, essentially, their incentive is to make trades, make transactions, even when they're not necessary. But exactly like you said, that's the suitability standard again, and it's easier to make a case for something being suitable than for something being truly up to the fiduciary standard.
Yeah. If we're going back to the dog analogy, financial advisors should be kept on a short leash, because if they're not on a short leash, then they'll not that they'll try to wiggle out, but it's just the temptation's going to be there to wiggle out and chase after that squirrel.
And you always, ultimately it comes down to being open to communication and asking those sometimes hard questions like, how are you getting paid, Mr. Advisor? And what are you spending your time on? That's a question that's related. And you want to hear that they're spending time actually serving clients and delivering value rather than time being spent just on increasing their book of business, because they won't get paid unless they get the next sale.
Yeah. So look for a fee-only advisor. That's the way to go. We actually have a question here. I think we can. The question is, how should a recent college graduate making $55,000 a year start to build a portfolio? Just and because every portfolio, especially when you're being held to the fiduciary standard, every portfolio is different. But what would just be some general guidelines you would give people?
Yeah. May I ask what the name of the person asking the question is?
Justin Parker.
Justin. Okay, awesome. Hi, Justin. I know Justin. Yeah. So, like Henry said, there's a lot of can't get into specifics really. As a fiduciary, you have to give advice within a relationship, within the context of knowing the full picture. But some principles are universal. And one of those is you want to avoid costs. Henry actually just last week talked about one of the highest principles of investing and financial success is don't lose money. And costs, so fees within, say, and trading costs or fees within a mutual fund, so like the expense ratio, those are losses from day one. So regardless of how the market's doing, if you're paying high costs either to make trades or just to be invested in a fund, that's violating rule number one: don't lose money. So there's a lot of options out there for kind of opening your own account and then investing in funds that are low expense ratio. And you also want to look for, if you look at more details of, say, a mutual fund, you want low turnover as well. That means what the fund is invested in isn't getting traded in and out a lot, because that just incurs that costs. There's cost every time trades within the investment are made, even if you're not trading in and out of something a lot.
Yeah, so looking for index funds that are low cost, low turnover. I think like you said, as far as the specific index funds, that'd be hard to give a recommendation, just because everybody's different, and some index funds are designed to be much more volatile, and I will say one thing, because before I started using index funds, there is a difference between saying, yeah, when the market goes down, I'm going to be fine and I'm going to buy, and it's another thing to actually experience it and to feel the bottom of your stomach go down, go out at the same time.
Yeah.
Because usually if the market's going down, there's other things happening in your life, and you got to just go, no, I have a plan. I swear, it's just stick to the plan. It's entirely different. So, but yeah, so low cost, low expense ratio, low turnover index funds.
I'm glad you mentioned the market going down too, because one more just big high level principle I'd add is be diversified, because when the market does inevitably go down, you're at so much more risk if you're holding one company, one stock, as compared to a whole basket of many stocks. So, if it's an index like the S&P 500, that's at least 500 stocks. That's better than owning one. But there's a lot of funds that track much bigger indices, because the S&P 500 is still just large companies in the US, and a lot of them are technology companies. So be diversified, not only across companies, but also across types of companies, different sectors, be diversified internationally, because that reduces your risk at no cost.
Yeah. And you said basket, and one of the things that kind of keeps coming, that I keep realizing over and over again, is that like old wisdom ends up becoming relevant again when you're talking about investing. Don't put all your eggs in one basket. What Bob keeps talking about, how farmer's wisdom of 1/3 to plant, 1/3 to eat, 1/3 to store. Like all these things keep coming back. So don't put all your eggs in one basket. You want different baskets, different types of baskets, maybe some buckets.
Exactly.
Yeah, diversification. That's huge. Great. Thank you so much, Justin. We actually, I said that we would probably hit, like, I'd be surprised if we hit 20 minutes and we're at a half hour. So this is, I'll tell you what, this is a lot easier when I can just, when I have a thought about talking about something and I can just go, oh, hey, Chris, can you talk about fee only? So yeah, I think that's about it so far. We had a great question. Remember, everybody, look for fee-only financial advisors. Try to find out exactly where your financial advisor's money is coming from. Are they getting it from you, or are they getting it as commission from a firm? Because we're all good dogs, but you don't want a dog that that's been trained wrong, basically. Besides that, Chris, any final thoughts?
No, I think that was it. This was awesome. Thanks for having me and doing this.
Yeah, thanks for joining. Yeah, I'm sure that you're going to be joining us a lot more in the future. So I'm looking forward to those as well. Thank you, everybody, again so much for joining us for Money Monday. I have to put the event invitation up on Facebook, but we have another. Actually, I'm going to put another plug in for Chris. We have another free webinar coming up at the end of March 25th at 4 p.m. Mountain, 6 p.m. Eastern. It's going to be on factor-based investing, and that Chris is going to actually be leading a good chunk of that. So, Justin, come on back, join us for that. Chris is going to do a great job explaining factor-based investing, because I'll tell you what, the internet actually doesn't do a great job of explaining it. But then you and Bob just were like, oh no, it's just these 5 things. Oh, okay, great, so simple. So I'm looking forward to that.
More details there for sure on kind of investment guidance. We started with some principles today, but that'll be more in depth. Yeah, thanks for that reminder, Henry.
Yeah, so thank you, Chris, and thank you, everybody, for watching. I hope everybody's having a good and safe day. Bye now.
Bye.